All right, let's jump right into SoFi Technologies and their first quarter of 2025. The numbers dropped before the market opened on Tuesday, April 29th.
Yeah, quite a bit to unpack there. Definitely some strong headline figures.
Absolutely. So they reported record GAAP net revenue, $771.8 million.
Right, and that gap figure, that's up 20% compared to Q1 last year. Pretty solid growth.
And the adjusted net revenue, even better, right? $770.7 million.
Exactly. That's a 33% jump year over year. And importantly, both those numbers beat what analysts were expecting.
Yeah, the consensus was closer to, what, $739 million? So a decent beat on the top line.
Definitely. And it also marks their sixth quarter in a row being profitable.
That's a key milestone, maintaining that profitability streak.
Now, looking at the net income itself, it was $71.1 million.
Which is actually down a bit, about 19% from last year, correct?
It is, yeah.
Yeah.
But they flagged that this was due to investments they're making for future growth, plowing money back in.
Okay, that makes sense. But the earnings per share, the EPS, that looked really good.
It did. $0.06 per share. That's a huge jump, like 200% from the $1.02 they had in Q1 2024.
And double the expectation. Right. Analysts were looking for 0 or 3S.
Exactly. So a really strong beat on EPS, and adjusted EBITDA also hit a record.
$210.3 million, I believe.
Yep, $210.3 million, up 46% year over year, giving them a pretty healthy 27% margin on that basis.
Okay, so overall, strong financial performance, beating expectations, continued profitability. Looks good on the surface.
It does. Now let's maybe dig into how they achieve that. Member growth is usually a big part of the SoFi story.
And it was again this quarter. They added 800,000 new members, a record number.
For record, yeah. That brings their total up to 10.9 million members, which is 34% growth compared to last year.
That's incredible scale. Didn't they say something about tenfold growth over 5 years?
They did. It really puts into perspective how rapidly they've expanded that member base.
And members mean products, right? How did that look?
Also strong. 1.2 million new products added in the quarter. That brings the total to 15.9 million products.
And that's up 35% year over year. So growth in members and products is pretty much in lockstep.
Pretty much. And what's really interesting is where that product growth came from. About 90% of it was driven by their financial services offerings.
So not just lending anymore. The banking and investing side is really pulling its weight.
Exactly. And the financial services segment numbers reflect that. Revenue there more than doubled year over year.
Doubled. To what figure?
$303.1 million, just for that segment.
Wow. And within that?
Well, net interest income was up 45%. But the non-interest income, that's things like fees, that quadrupled compared to Q1 last year.
Quadrupled. Okay, that's significant diversification away from just interest.
Absolutely. And it shows in the segment's profitability, too. The contribution margin hit 49%. Very efficient.
Okay, so financial services is clearly a huge engine now. What about the tech platform? Galileo and Technisys.
That segment brought in $103.4 million in revenue. That's up 10% year over year.
Slower growth than financial services, but still growing.
Yes, steady growth. And they highlighted adding new clients outside of the usual fintech space, like Wyndham Hotels and Mercantile Banco.
Expanding their reach. Any forecast for that segment?
They mentioned expecting a medium-term CAGR, compound annual growth rate, in the mid-teens for the tech platform.
Okay, so solid, predictable growth expected there. Now let's talk about the traditional lending side.
Right, the lending and platform business. Originations hit a record $7.2 billion in Q1.
$7.2 billion. And any specific area standing out?
Home loans were up significantly, 54% growth in originations there.
Okay, but student loan refinancing, still tough, I imagine.
Yeah, they noted that remains challenging. It's been a headwind for a while now.
But they're leaning into this credit platform business idea, right? Originating loans for others.
Exactly. That's a big strategic push. They originated $1.6 billion for third parties in Q1.
And they've secured commitments from partners.
Yeah, over $8 billion in new commitments from firms like Blue Owl and Fortress. The idea is to, take some load off their own balance sheet.
And diversify revenue streams away from holding the loans themselves. Makes sense. Did that platform contribute much revenue yet?
It did. $96.1 million towards adjusted net revenue in the quarter. So it's already a meaningful contributor.
Got it. Another key part of their strategy is deposits, leveraging that bank charter.
Hugely important. Total deposits reached $27.3 billion.
And most of that is from their own members.
Over 90%, yeah. Which is crucial because it's a very low cost and stable source of funding for their lending.
How much cheaper is it?
About 189 basis points cheaper than using warehouse facilities.
And what does that translate to in savings?
They estimate it saves them around $515 million in interest expense annually.
Right.
That's a massive advantage from having bank charter.
Definitely underscores the value of that charter and fee-based revenue overall.
Also a record, $315.4 million, up a huge 67% year over year.
And that helps reduce their credit risk exposure too, right?
Exactly. Because it's not directly tied to loan performance.
Oh.
If you combine the revenue from financial services and the tech platform, it was up 66% to over $406 million.
So a big chunk of their revenue is now coming from these less credit-sensitive areas.
Precisely. Which leads us nicely into credit performance itself. How are the loans actually doing?
Yeah, especially given the talk about a, tougher consumer credit environment.
Well, SoFi actually showed improvement. The annualized net charge-off rate on personal loans, it actually dipped slightly.
From what to what?
From 3.37% in Q4 last year down to 3.31% in Q1 this year.
Okay, so charge-offs are actually trending down slightly. What about delinquencies?
Also improving. The 90-plus day delinquency rates decreased for the fourth straight quarter.
Fourth quarter in a row. That seems to suggest their underwriting and risk management are holding up well.
It certainly points that way, yeah. Despite the broader environment, their specific portfolio seems to be performing quite well.
Given all this good news, did they update their guidance for the rest of 2025?
They did. They raised the full-year guidance.
Do we know the new numbers, or just that they raised them?
They didn't give the specific new range in the summary we have, but they explicitly raised it from the previous guidance.
Which was? Remind me.
Previously, they expected at least 2.8 million new members and adjusted net revenue between $3.20 billion and $3.275 billion.
Okay, so raising guidance off that base shows quite a bit of confidence from management for the rest of the year.
Absolutely. Strong Q1 performance translating into increased optimism.
Okay, so fundamentally, the business seems to be firing on, well, most cylinders, but how is the stock actually reacting?
Well, that's where the picture gets a bit more complicated. Year to date, the stock is actually down quite a bit.
How much down?
Depending on the exact start date, somewhere in the range of like 20% to 29%.
Even after this strong earnings report.
Well, the report just came out. On the day before earnings, April 25th, it closed at $12.88, which was actually up over 4.5% that day.
But the longer-term trend hasn't been great.
Right. Since their last positive earnings call, the stock is apparently down over 28%, and it's known for being quite volatile day to day, high risk.
So what are analysts saying? Is there a consensus view?
The overall consensus rating is hold. Not a strong buy, not a sell, just hold.
And price target.
The average 12-month target is somewhere between $13.23 and $14.15, depending on the source.
Which isn't dramatically higher than where it was trading just before earnings.
No. And there's a huge range in those targets. The highest estimate out there is $20, but the lowest is just $5.
Wow, $5 to $20. That's a massive disagreement among analysts.
It really is. You do have bulls, though. Like Devin Ryan at Citizens JMP, he's maintained a buy rating and a $17 target.
What's his reasoning?
He points to the growth, the rising profitability, and basically thinks it's undervalued. Calls it an inflection point story with exceptional growth potential.
Okay, so the bullish case is still alive. But what about the other side? Any specific valuation models?
Yeah. Guru Focus's GF value model, for instance, actually suggests the stock might be overvalued and has potential downside, maybe around 19%.
So conflicting signals on valuation too. What about technicals? Any chart signals?
It's mixed there as well. Short-term and long-term moving averages were apparently giving buy signals individually.
Okay.
But the fact that the long-term average is above the short-term average can be interpreted as an overall sell signal by some technicians.
Right, this so-called death cross pattern, potentially. Any positive technicals?
Well, the recent price increase did come with higher trading volume, which is generally seen as a positive confirmation.
Okay. And finally, insider activity. Are executives buying or selling?
The data points towards more selling than buying recently. A negative insider power ratio was mentioned, negative 52.107.
Meaning insiders, over the last 100 transactions or so, have sold more shares than they've bought.
Correct, which, can sometimes be seen as a lack of confidence, though there can be many reasons for insiders to sell.
Sure, it could be diversification, taxes, anything, but it's another data point.
Exactly. So to kind of wrap it all up.
Yeah, let's try and summarize. We've got strong Q1 financials, right? Beat revenue, beat EPS significantly, sixth profitable quarter.
Right. Driven by really impressive member and product growth, especially in financial services. The deposit base is a huge plus, saving them money. And credit quality looks good, even improving.
And management is confident enough to raise guidance for the full year.
Check, check, and check. All sounds pretty positive from a business fundamentals perspective.
But then you look at the market reaction. The stock is down year to date. Analysts are mostly on hold with widely varying targets. And you have conflicting signals on valuation and technicals.
It creates this real disconnect, doesn't it? Strong operational performance versus kind of lukewarm, volatile market sentiment.
It really does. You have the bull case seeing an undervalued growth story at an inflection point, and the bear case perhaps worried about valuation, competition, or the broader macro risks despite the good results.
It makes SoFi a really interesting but also complex company to follow right now. The fundamentals look good, but the market isn't fully convinced yet, it seems.
Definitely a complex picture for anyone watching SoFi. It'll be fascinating to see how this gap between performance and perception plays out.
Absolutely. The next few quarters will be key to see if they can sustain this momentum and maybe win over more market confidence.
Well, that brings us to the end of our look at SoFi's Q1. Thanks for walking through those numbers.
My pleasure. Lots to think about there.